Today, we are jumping headfirst, really, into the world of crypto investing. It can be, well, pretty unpredictable, right? So our goal here is to give you a kind of survival guide. We want to help you dodge the top 10 mistakes that we see new crypto investors making, especially now in 2025. We've gathered insights from some expert analysis and recent industry reports to give you a shortcut, really, to getting properly informed.
Exactly. And it's not just about listing the mistakes. We want to dig into why they happen. Understanding that why helps you build, more disciplined, smarter approach to crypto.
Okay, let's unpack this survival guide then. So mistake number one, and it's a big one, basically not doing enough research, just jumping in. You see it all the time, right? People get swayed by hype. Maybe an influencer shouts about a coin or
seeing a price shoot up. Yeah. It's that classic DYOR, do your own research step that gets skipped. And skipping it leads to, well, bad choices. Or worse, getting caught in scams.
So what does real research look like then, beyond just glancing at a website?
Oh, it's much deeper. You need to actually read the white paper. Understand the tech, the team behind it. Are they credible? What's their background? Look at the tokenomics, the use case. Is it solving a real problem? It's foundational stuff that's surprisingly often just ignored.
Right, and ignoring that groundwork makes you a prime target for mistake number two, falling for scams and phishing. We've all seen those offers, the ones that seem way too good to be true.
Definitely. And the crypto space, unfortunately, is just rife with them. Fake projects, phishing attempts, rug pulls. New investors are often lured in by these promises of guaranteed huge returns, which should always be a red flag.
So how can you actually spot these? What are the telltale signs?
Well, guaranteed returns is a big one. High pressure to invest now.
Sure.
Anonymous teams can be risky. Poorly written websites or white papers. You develop a sense for it, but skepticism is key.
Okay, makes sense. Now, mistake number three often comes from emotion, right? Overinvesting. Putting in more money than you can actually afford to lose. I think FOMO, that fear of missing out, is a huge driver here. You see prices climbing and you just want in.
It's a powerful psychological trigger, especially in a 247 market like crypto. But it can lead to real financial hardship if the market turns. That's why the golden rule is, and always will be, only invest money you can truly afford to lose completely. If we connect this to the bigger picture, it's about managing those emotional reactions, not letting FOMO dictate your decisions.
Right. And closely related is mistake number four, neglecting basic security practices. This seems so fundamental, but, using weak passwords, not bothering with two-factor authentication, things like that.
Yeah, and it makes investors prime targets for hacks and theft. It's crucial. Use strong, unique passwords. Always enable 2FA, preferably using an authenticator app, not just SMS. And understand the difference between keeping funds on an exchange versus in your own secure wallet. What stands out here is just how basic yet vital these steps are. Don't leave large amounts on exchanges.
Use a hardware wallet for significant sums.
Absolutely. Cold storage, like a hardware wallet, keeps your private keys offline, away from online threats. It's a must for serious HO dealing.
Okay, next up, mistake number five, ignoring diversification. Essentially putting all your eggs in one basket.
Or maybe just two baskets, like only Bitcoin and Ethereum.
Yeah.
And while conviction is good, putting everything into one coin or even one sector of crypto is incredibly risky. If that one asset crashes or that project fails, you could lose everything. Real diversification means spreading investments across different types of crypto assets, different sectors, maybe some DeFi, some layer 2s, perhaps even a tiny bit in high-risk altcoins balanced with stablecoins.
It's about spreading the risk, basically.
Precisely. Balancing that risk profile is key.
Now, mistake number six. This one's tempting for newcomers. Overtrading and chasing those short-term gains. Trying to time the market perfectly, make a quick buck.
Yeah, the allure is strong, but it almost always leads to losses. You rack up trading fees, you make emotional decisions based on short-term volatility. It rarely works out. It reinforces this idea that crypto is not a get-rich-quick scheme. Patience and a long-term view usually win out.
So what does this all mean for your strategy?
It means focus on a solid, long-term plan. Don't constantly react to every little price swing.
Which ties directly into mistake number seven, having unrealistic expectations. Believing in overnight riches, trusting influencers, promising, 100x gains guaranteed.
Exactly. That mindset just sets you up for disappointment and encourages reckless behavior, like the overtrading we just discussed. Again, crypto is rarely a get-rich-quick scheme. Manage those expectations. Think long-term. Think sustainable growth, not lottery wins.
Okay, this next one, at number 8, sounds almost basic, but it can be devastating. Forgetting wallet passwords or losing your private keys.
Oh, it's heartbreaking when it happens. And it happens more than you'd think. Losing access to your wallet password, or especially your seed phrase, those 12 or 24 words, can mean permanent loss of funds. There's no forgot password link for your private keys.
No customer support to call.
None. You are the bank. And many new investors just underestimate how critical secure key management is. They write it down carelessly, store it digitally. Big mistakes.
So how are you managing your digital assets? That's the question people need to ask themselves.
Absolutely. Securely. Offline. With backups.
Right. Mistake number 9, making transaction errors, like sending crypto to the wrong address.
Oof. Yes. Or sending the wrong type of coin to an address.
Is that really irreversible?
Completely.
Yeah.
Blockchain transactions, once confirmed, cannot be undone or reversed. If you send your Bitcoin to an Ethereum address, or just mistype one character in a long address, poof, it's gone.
What?
There's no bank to appeal to. No chargeback. What's fascinating here is that finality. You have to be incredibly careful. Double check, triple check every single transaction detail before you hit send.
Okay, last one on our list, number 10. Choosing the wrong exchange or platform. Are all platforms basically trustworthy?
Absolutely not. Far from it. Using unregulated, insecure, or frankly scammy exchanges is a huge risk. We've seen major exchanges collapse, taking user funds with them. You need to do your homework.
What should you look for?
Check their security measures, their regulatory status in your country, user reviews, withdrawal policies, proof of reserves if they offer it. Don't just pick the one with the flashiest ads or the lowest fees. Research is essential before you deposit any money.
So we've covered a lot of ground, 10 major pitfalls. Looking back over them, what's the common thread?
Well, if we connect this to the bigger picture, I think the common threads are impatience, a lack of thorough education, emotional decision-making, and often just neglecting basic security and risk management. Avoiding these really comes down to patience, doing the work, having a clear strategy, and being disciplined about security.
Yeah, that really sums it up. Crypto investing can be rewarding, definitely. There are amazing opportunities, but only, and this is the key part, only if you approach it with caution, discipline, and a commitment to keep learning. So what does this all mean for you, the listener? It means you're now armed with the knowledge to navigate this space more safely, use these insights.
And maybe a final thought to leave you with. In a space like crypto that changes so fast, where there's so much noise and information, not all of it reliable, how much of being successful isn't just about avoiding these mistakes, but about constantly questioning your own assumptions, adapting to new information, and really embracing that mindset of being a lifelong learner in this digital frontier?